Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. In this audio, we're going to talk about supplemental disclosure of balance sheet. Besides those account and values listed on the balance sheet, firms are also going to provide some of the important supplemental information in somewhere else on the financial report, for example, footnote. So those information will be very important for us to be able to understand those line items on the financial statements. There are basically 4 types of supplemental disclosures: contingencies, accounting policies, contractor situations, and fair value disclosure. Next, we're going to talk about them one by one. First of all, contingencies. Contingencies means those material events that have an uncertain outcome, which means that it will be realized in the future. However, right now, we don't know yet. For example, lawsuits. For the contingencies, we have 2 types of contingencies: contingent loss, which is bad; contingent gain, which is good. However, you can see that the accounting disclosure for these 2 types of contingencies are different. For the contingent loss, if it is highly probable and the dollar value is estimable, we're going to accrue it. Accrue means that recognize them and put on the financial statements. If it is highly probable, however, the dollar value is not estimable or it is reasonably probable, we're going to disclose it. If it is remotely probable, we're just going to ignore them. However, in the practice, most of the time, for the loss contingencies, company will at least disclose them in the footnote. For the contingent gain, you can see that regardless of how highly probable this contingent may happen, we're just going to disclose it at most. Most of the time, we're going to ignore them. So we can see that this is an asymmetric disclosure between contingent loss and contingent gain. Again, this is a reflection of our accounting conservatism. This is a loss contingencies disclosure, footnote disclosure, for Mattel Corporation in 2007. In this year, this company had 22 lawsuits about their products related to the product recalls and withdrawals across the whole United States. So in a footnote, they disclosed this. However, since they cannot reasonably determine the scope or the amount of the possible liabilities, they just disclose in a footnote instead of putting on the financial statements. Although they're going to defend themselves very vigorously, they also warned the readers of the financial statement that it is possible that an unfavorable resolution of the claims could have happened. So this is an example of the loss contingency disclosure. The second type of supplemental information provided by the companies are accounting policy explanation. So companies are required to explain their evaluation method and assumptions used when they record those economic transactions. For example, this is inventory footnote of Cisco. In this footnote, Cisco provided the following 2 pieces of information. First of all, they use FIFO to evaluate their inventory to calculate the cost of goods sold. And secondly, the end inventory are stated at the lower cost or market, which means that inventory is written down if its replacement cost referred to the market declines below its balance sheet cost. So the market here actually estimated based upon the assumptions about future demand and charge the provision for the inventory, which means that if there's any loss occurs because the market value is lower down, then they're going to recognize losses, and this loss will be recognized on the income statements. The third type of supplemental information provided by companies are contractor situation. Here, companies are going to explain their restrictions or covenants attached to certain assets or liabilities. For example, their lease contracts, pension obligations, stock option plans. Look at this example downward. This is the lease contract related information of Delta Airlines in 2001. In this schedule, they provide information very importantly, the total minimum lease payment in the future years related with their capital leases and their operating leases. And we know that the lease contract for this type of companies are very material. The last type is fair values. Here, companies are going to disclose fair values of financial instruments. Financial instruments are defined as, first of all, cash, obviously. Secondly, ownership interest. For example, companies could have stock investments in other companies. Thirdly, a contractual rights to receive cash, for example, accounts receivable, or contractual obligation to deliver cash or another financial instruments, for example, accounts payable. So all these asset and all liabilities are actually disclosed at the historical values on the financial statements. In the footnotes, companies are also required to disclose their estimated fair values, which actually provides additional important information to the readers.